Your money is losing value right now, not because you're spending it, because inflation is quietly eroding your wealth while you sleep, and most people have no idea which assets can actually protect them from the cost of living increases that never stop. This video explains 3 asset categories that have historically survived inflation, and why they work. Inflation feels abstract until you're standing in a grocery store paying 40% more than you did 3 years ago for the same items, same cart, same products, different price. That's not companies being greedy, that's your currency losing purchasing power. The dollar in your pocket buys less than it did, and every year that gap widens. This isn't news, this isn't opinion, this is a system-level explanation of how inflation operates. And once you understand the mechanism, you can see why certain assets hold value while cash loses it, because inflation doesn't affect all assets equally. Some collapse, some survive, and a small number actually preserve wealth across decades of currency debasement. The question is which ones, and why. Inflation is not prices going up, that's the visible symptom. The actual mechanism is your currency losing value. When central banks expand the money supply, each individual unit of currency represents a smaller fraction of the total. More dollars chasing the same goods means each dollar is worth less. Prices don't rise because things got scarce. Prices rise because the measuring stick shrank. This destroys wealth in a specific way. If you hold cash or cash equivalents, the real value of that wealth declines every year. $100,000 in 2020小时 at the purchasing power of roughly $78,000 by 2024. You didn't spend it, the system reduced its value. And this isn't new, this is how inflation has always worked. The Roman Empire debased its currency by reducing silver content in coins. Weimar Germany printed money until the currency became worthless. Every fiat currency in history has eventually lost purchasing power. The pattern repeats, the mechanism stays the same: more currency units, less value per unit, wealth erosion for anyone holding cash. But here's what history also shows: while cash loses value during inflation, certain assets retain it, not because they're magic, because they have characteristics that resist inflationary pressure: scarcity, tangibility, historical acceptance, difficulty to replicate. These characteristics create what economists call an inflation hedge, an asset that maintains or increases its real value when currency value falls. There are 3 categories of assets that have historically functioned this way. They're not perfect, they don't always work, but over long time horizons, they've protected wealth better than holding cash. This is pattern analysis, not investment advice. The goal is understanding, not recommendations. The first asset category is precious metals, specifically gold and silver. These metals have been used as stores of value for over 5,000 years, across empires, across currencies, across economic systems. Why do precious metals hold value during inflation? Because they're scarce. You can't print gold, you can't create silver with a keystroke. The supply is limited by physical mining, and mining is expensive, slow, and geographically constrained. When central banks expand fiat currency supply, the amount of gold in the world doesn't change, so the ratio shifts: more currency per ounce of gold, which means gold's price in that currency rises, but the real value didn't change. The currency value fell, gold just maintained its purchasing power relative to goods and services. Historical example: in 1971, gold was $35 per ounce, today it's over $2,000 per ounce. That looks like gold went up, but what actually happened is the dollar lost over 98% of its value relative to gold. 1 ounce of gold in 1971 could buy a quality men's suit. 1 ounce of gold today can still buy a quality men's suit. The purchasing power remained stable, the dollar amount changed because the dollar weakened. This is why institutions hold gold: central banks, sovereign wealth funds, large financial institutions. They're not speculating, they're preserving wealth across currency cycles. But gold has limitations: it generates no income, no dividends, no interest. It just sits there, holding value, which makes it effective for preservation, but not for growth. And gold can fail as an inflation hedge in specific conditions: if governments confiscate it, if transaction costs become prohibitive, if a new form of money replaces it entirely. In 1933, the US government made private gold ownership illegal and confiscated gold at a fixed price. citizens were required to sell their gold to the government. Holding gold didn't protect wealth if the government simply took it, so precious metals work, but only in systems where property rights are enforced and ownership is protected. The second asset category is productive real assets: land, real estate, infrastructure. These are physical assets that generate economic value over time. Why do productive real assets survive inflation? Because they produce income that adjusts with inflation. If you own an apartment building, rents typically rise during inflationary periods. Your costs rise too, but rental income tracks inflation more closely than fixed income assets like bonds. Real estate is particularly effective because it combines scarcity with productivity. They're not making more land, and people always need places to live and work, so demand persists even as currency weakens. Historical example: agricultural land in the United States. An acre of Iowa farmland cost roughly $200 in 1970. Today that same acre is worth over $8,000, but the productivity of that land remains similar. It grows roughly the same amount of corn per acre. What changed is the dollar value of the output. Corn prices rose, land prices rose, because the currency weakened. An investor who bought farmland in 1970 preserved wealth, not because land became more valuable, because currency became less valuable, and productive assets adjust. Institutions understand this: university endowments, pension funds, sovereign wealth funds. They hold significant allocations to real assets: farmland, timberland, infrastructure, energy assets, not for speculation, for inflation protection. But real assets have risks. They require management, maintenance, property taxes, insurance, regulatory compliance. You can't just hold them passively like gold. And real assets can lose value if economic conditions change structurally. Commercial real estate in declining cities, farmland in areas with water shortages, infrastructure in obsolete industries. The asset must remain productive. If the underlying economic demand disappears, the inflation hedge disappears too. So real assets work, but only if the productivity persists and the costs don't overwhelm the income. The third asset category is equity in productive businesses: stocks, ownership stakes in companies that generate earnings. Why do equities protect against inflation? Because companies can raise prices. When input costs rise due to inflation, businesses pass those costs to customers. Revenue increases in nominal terms, earnings adjust, and stock prices tend to follow earnings over time. This doesn't mean stocks always rise during inflation. Short-term volatility is high, but over decades, equity ownership has historically outpaced inflation. The mechanism is simple: a company that sells products can charge more when currency weakens. $100 of revenue in 2020 might be $130 of revenue in 2024. For the same volume of goods sold, the business didn't grow, the currency shrank, but shareholders benefit because earnings are reported in nominal currency terms. Historical example: the SP 500 index. In 1980, the index was around 100. Today it's over 5,000, that's a 50 times increase. But much of that increase is inflation. Corporate earnings rose, not always because companies got better, often because the dollar got weaker, and earnings measured in weaker dollars look bigger. An investor who held diversified equities from 1980 to today preserved and grew wealth, not just from business growth, from currency debasement that flowed through to nominal earnings. This is why equity markets tend to rise over long periods even when economic growth is modest. The underlying currency is losing value. Stock prices adjust to reflect that. But equities have significant risks during inflation. If inflation rises faster than companies can adjust prices, profit margins compress. If central banks raise interest rates to fight inflation, stock valuations fall. The 1970s showed this clearly. Inflation was high, but stock markets were flat for an entire decade, because interest rates rose, valuations compressed, and companies struggled to pass costs through fast enough. So equities work as an inflation hedge over very long time horizons, but they can fail badly during the transition periods when inflation is accelerating or when policy responses create volatility. Now let's compare these three asset categories: precious metals, productive real assets, equities in businesses. Each one works, but each one works differently, and each one fails under specific conditions. Precious metals preserve value passively. They don't grow, they don't generate income, They just sit there holding purchasing power, effective if you need stability, ineffective if you need growth or cash flow. Productive real assets generate income that adjusts with inflation, but they require active management, costs, taxes, regulatory risk. Effective if the underlying asset remains productive, ineffective if demand shifts or costs spiral. Equities offer growth potential and income through dividends, but they're volatile, sensitive to interest rates, dependent on corporate execution, effective over decades, ineffective during periods of rapid inflation or policy tightening. No single asset is perfect, because inflation itself is a system-level force. It doesn't care about your portfolio, it just erodes currency value, and different assets respond differently at different times. The pattern that matters is this: cash always loses, hard assets tend to hold, productive assets tend to adjust, and the timeline determines which one works best. If you need to preserve wealth for 6 months, none of these matter. Inflation won't destroy you in 6 months. But if you need to preserve wealth for 20 years, holding cash guarantees loss, and allocating to assets with inflation-resistant characteristics becomes essential. This isn't speculation, it's historical pattern recognition. Now connect this to today's inflation environment. The cost of living has increased significantly since eroding. Groceries, rent, insurance, energy, healthcare, education. The official inflation numbers say inflation is moderating, but those numbers measure year-over-year change, not cumulative impact. If prices rose 20% over 3 years and then inflation drops to 2%, prices don't go back down, they just stop rising as fast. The cumulative damage remains. Your paycheck might grow 3% annually, but if your costs grew 20% cumulatively, you're still behind, and that gap compounds over time. This is persistent inflation pressure, not hyperinflation, not crisis, just steady erosion of purchasing power that never reverses. And in that environment, holding cash means accepting guaranteed loss of real wealth, because cash doesn't adjust, it just sits there losing value every year. Assets adjust, some faster, some slower, but the mechanism is the same. When currency weakens, assets denominated in that currency reprice. Gold reprices, real estate reprices, stock prices reprice, not because the assets changed, because the measuring stick changed, and the longer inflation persists, the more pronounced that repricing becomes. This is why understanding asset behavior during inflation matters, not for trading, not for timing markets, but for long-term wealth preservation in a system where currency debasement is structural. So here's what we've covered. Inflation erodes wealth by reducing currency value. Cash loses purchasing power over time. Certain assets historically resist that erosion. Precious metals hold value through scarcity. Productive real assets generate inflation-adjusted income. Equities reprice as nominal earnings rise. None are perfect, all have risks, but all have characteristics that make them more effective than cash during prolonged inflation. The takeaway isn't which asset to buy, the takeaway is understanding how inflation works, how it transfers wealth, and why certain assets have survived every inflationary period in recorded history. Because inflation isn't new, currency debasement isn't new. The pattern has repeated for thousands of years, and the assets that protect wealth during those periods share the same fundamental characteristics: scarcity, tangibility, productivity, difficulty to replicate. Now you understand how inflation quietly reshapes wealth, and why the assets you hold matter more than the income you earn when currency value is falling.